price of gold differential between China and the US always fluctuates based on what China is doing with their capital controls. They are manipulating, and I use this word sincerely, they are not manipulating price, they're manipulating demand. They're trying to protect the yuan, therefore you can't sell yuan and buy dollars to buy gold. Gold suffers, that type of stuff. China wants all the gold it can take, all of it, okay? They are buying the gold, they're not selling the gold. Maybe they're restricting their people from buying gold so they can sell it to them directly, but that's the point. China restricts export of gold, not import of gold.
China has been quietly but consistently increasing its gold reserves while simultaneously reducing its holdings of US Treasuries, a move that has garnered attention from financial experts worldwide. The rationale behind this shift and its potential implications for global markets are subjects of ongoing analysis. According to Vince Lanci, the price differential between gold in China and the United States fluctuates based on China's capital controls and their efforts to manage demand rather than manipulate the actual gold price. China is not trying to manipulate the gold price itself, but rather, they are manipulating demand to protect the yuan. Data from the World Gold Council reveals that China purchased 23 tons of gold in July, bringing its total net gold acquisitions for 2023 to 126 tons. As a result, China's gold reserves now stand at approximately 2136 tons, representing roughly 4% of the global gold reserves. Gold in China is trading at a record premium to international prices, a sign of Beijing's escalating battle to defend its currency. Bullion on the Shanghai Gold Exchange traded at a premium of more than $120 an ounce on Thursday, according to calculations by Bloomberg. That's the highest since the exchange was founded over 2 decades ago, as a weak yuan drove up prices in recent weeks. Vince sees that the price differential observed in China's gold market, particularly on the Shanghai Futures Exchange, reflects the capture of domestic demand by China itself. China has managed to keep this demand within its own exchange through strict capital controls and regulations, sometimes unintentionally restricting inflows. Regarding China's capital controls and their approach to managing the flow of currency, it's crucial to understand that they use these controls to influence and support the yuan. Capital controls can include restrictions on converting yuan to other currencies like the US dollar. These measures strengthen the yuan and control the flow of money in and out of the country. We will now bring you clips from Vince Lanci's interview with Arcadia Economics. But before we do, if you want more videos like this, hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
China, there are 2 things going on, and I know you want to talk about both, but the first one is, how does China's policy affect the price differential? That's one question. And the other is, what is going on globally, more or less tied to the mines and the vaults, that is creating this or contributing to this in a more secular way? So what we're looking at now is, and you and I were doing the math off the screen, before recording, is that the price in China on the Shanghai Futures Exchange, which 10 years ago nobody cared about, right? Now they got a lot of volume. Now they got a lot of the demand, right? China has effectively captured their domestic demand and put it on their own exchange. And so that price differential is a reflection of Chinese demand being captured and Chinese rules and capital controls keeping that demand there, and sometimes inadvertently or intentionally restricting inflows in. First of all, to separate the global change in how precious metals are viewed from the policy changes in China, staying with the policy changes, I think let's pretend that nothing was going on in the world. Everyone was happy and the COMEX was still filled with silver and everybody was just joyful. We would probably not be looking at the Chinese price differential in such a narrow way, like, oh my goodness, what's going on there? Because that price differential would be arbed away over time. Now, even without a global problem, this price differential is a reflection of a potentially chronic problem in China, not related to gold, but related to gold in terms of how it affects price. If you want, I could just get right into the nitty-gritty of what's going on over there.
Sure.
Right. Now, I'm not 100% on this, but the people that I've talked to, Bai Xiaoping and others who represent both sides of the equation, and plus my own experience, It goes like this. In China, they prefer to use capital controls to support, or it's all about the yuan. They prefer to use capital controls to support, to direct the flow of currency in and out of their country. They're not a free market in this sense. So capital controls would be, hey, if you're a Chinese citizen, you're not allowed to convert your yuan into dollars. So, and what that does is it strengthens the yuan. I'm not saying that they're doing that now, but they are. And it strengthens it against the dollar. Sometimes it's used as a countermeasure to other policies, but they basically restrict the flow of money into what you can buy. So if you have an economy such as China's, which right now, this is my opinion, that is struggling to come out of its COVID deflation or disinflation, they're going to start using stimulus. And I don't pretend to know what their logic is, and I'm not saying it's bad logic, but China will do various things and add things to the mix to support or weaken the yuan while they're rescuing one company, or they're letting one company fail, or they're trying to attract foreign money. It's a very big, complex calculus that I don't pretend to know. Two of the things that will affect gold are, one, if you have an increased demand in gold, and this is what the people describing the problem as being a restriction of gold imports. Okay, to my knowledge, that's not what's going on. It may be effectively restricting gold imports, but there's no prohibition.
Silver prices fell significantly in recent weeks, dragged down by concerns over Chinese demand, a strong recovery in U.S. yields, and a firmer dollar. Lanci points out that China's domestic silver production falls significantly short of satisfying its substantial demand. The nation mines approximately 1 million ounces of silver, but requires 5 million to meet its needs. To bridge this gap, China sources the additional 4 million ounces from various global suppliers, which includes the London COMEX and several countries. JP Morgan emerges as a key player in facilitating these transactions. When China no longer conducts these silver transactions through traditional exchanges, due to reasons such as disruptions in the supply chain or geopolitical concerns, they turn to JP Morgan for assistance. Lanci emphasizes that despite China's evolving silver acquisition strategies, the COMEX continues to play a pivotal role in the silver market. While China may not exclusively rely on the COMEX for these transactions, it remains a foundational reference point. In other words, the COMEX's published silver prices serve as a benchmark that helps establish the market's pricing expectations. Let's get back to the interview.
Silver supply that they pull out of the ground isn't enough to satisfy their domestic demand. So they pull out 1 million ounces, they need 5 million. So they go all over the world getting 4 million ounces. London, COMEX, a couple countries here and there, right? But JP Morgan is, I'm making this up, it might not be JP Morgan. JP Morgan is a bank that helps them do that. Well, if they're not using the exchange anymore, the bank calls JP Morgan up and says, dude, I don't have my network anymore. I can't trade with this country. America gets mad if I do that. The supply chains have broken down. What do I do? And JP Morgan says, I know who makes the silver. And they broker a deal. That's what banks are. They broker a deal. They go to the guy in Mexico and goes, hey, how'd you like to have your silver supply taken every month for the next 5 years? And so China gets a deal done with a Mexican miner. It's happening right now. Now, does that make COMEX irrelevant? No. See, first they pull all the silver out of COMEX that they can. And then they figure out how to certify silver, or certify it, assay it, however you want to, so that it's up to spec. But they still use the COMEX price for deals. Now, I don't mean they use that price. I mean, Mexico says, I will sell you 100 million ounces. And China goes, I will buy them. What's the price? It's COMEX plus $2. It's a reference point. You see this in oil all the time, right? It's not the price that the institutions trade off of. It is the price that they reference, because it is still transparent. Miners are already doing business with countries off exchange, directly or through their bullion banks that represent them. You see it in Ghana. When Ghana says to Newmont, sell us some of your gold directly, we're going to use it for fuel oil. That's a deal. They're nationalizing a portion of their gold that way, right? In Latin America, when Mexico says our workers are going on strike because we want to get more money from Newmont to pull silver out of the ground, that's Mexico saying we're nationalizing our mines little by little. U.S. is doing it too. You can't get your silver out of the U.S. and go to another country unless you go through a know your customer routine. So the miners are already trading off exchange. What we used to call the OTC market or the physical market is going to grow in private deals. Remember, before there were exchanges, there were businessmen. And with the exchange gone, the price is the only thing, the last thing that we'll know about, and we'll still trust it even though no one else is using it. It's already happening. The COMEX price is getting out of hand relative to the China price. Are we going to knock the China price down? No. Are we going to complain about it? Yes, but not about silver. They never talk about silver. Notice that? Green metal. Let's talk about copper. Let's talk about platinum coming back on the scene. They don't talk about silver. Silver is really just too important. I mean, it's in many ways, it's more important than gold. That's my opinion. But what can they do? Well, the U.S. can use capital controls, and they're already using them, but they're not using them in the way that China is using. They're restricting the ability to export gold and silver. They're moving the silver from the COMEX vault to the SLV vault. What they're doing is I guess the simple way to look at it is, yes, they could do that. They could do something to make these prices converge. But because China's strength has grown in the precious metals demand area, it might converge at the higher price. So they don't want to. As long as the differential isn't being noticed in the mainstream, they'll let it stay and say, that's the COMEX price. That's the price. That's the only price we care about. All they're going to do is, as long as that price stays low, Chris, as long as that price stays low and people are willing to sell at that price, then the U.S. is the buyer. The U.S. will buy all the silver it can at that price.
China's strategic shift towards increasing its gold reserves while reducing its exposure to US Treasuries underscores an evolving dynamic in global finance. While the precise motivations behind this maneuver remain open to interpretation, it reflects a broader trend of central banks worldwide adjusting their portfolios in response to changing economic conditions and monetary policies. What are your thoughts on China's increasing gold reserves and its impact on the global economic landscape? Share your thoughts in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.